This week, headlines screamed oil shock and policy drama. The market, it kept trading rotation and resilience. Welcome to Capital Sound's weekly wrap. I am Mandy Prince here with Arjun Desai to break down why the tape ignored the noise and what really moved the macro narrative. Before we dive deep, let's set the scene. This was a week where the big indexes moved modestly, but leadership shifted under the surface. The mega cap trade cooled, while cyclicals and smaller names had more of the spotlight. Rates ticked higher, the dollar firmed, and volatility stayed calm. Breath was better than it looked on the surface, which is why investors felt less anxious than the headlines suggested. Arjun, let's start with the big macro story everyone argued about: the oil shock and how it reshaped inflation expectations.
The takeaway is simple. A sudden energy shock reframes inflation math faster than any speech or dot plot. When crude jumps toward the high end of recent ranges, it is not just gasoline, it is transportation, production costs, and consumer expectations. In valuation terms, the discount rate risk shifts up and the cash flow margin risk shifts down. That is a double hit for long duration equities. The narrative moved in a day from disinflation is resuming to what if energy drags inflation higher for longer. My DCF framework starts by asking what is the cost of capital and how stable are forward margins. A jump in energy costs threatens both. Companies with strong pricing power can pass through higher input costs. Those without it see margin compression. So the market didn't just panic, it quietly repriced, which businesses can defend cash flows in a tougher cost environment.
Let's slow this down for listeners. You are saying the oil shock was less about the price at the pump and more about the market reassessing who can protect margins.
Exactly. Investors don't need to know the precise oil price to adjust valuations. The question is, does higher energy create a higher hurdle rate for new investment and a weaker earnings profile for some sectors? In my models, I run scenarios. In the optimistic case, energy normalizes quickly and margins revert. In the base case, the shock is temporary but lingers for a few quarters. In the cautious case, energy stays elevated long enough to anchor inflation expectations higher. That last scenario widens the spread between companies with strong pricing power and those without.
That helps. And the tape showed that split energy and parts of industrials held up, while some growth stories felt heavier. But here's my question: isn't an oil shock usually bad for everything? Why didn't we see a broad-based risk-off move?
I'd push back on the idea that it is uniformly bad. It is selectively bad. It is a redistribution of pricing power. The market wasn't ignoring risk. It was reallocating toward businesses that benefit from higher commodity prices or can defend margins. Think of it as the market saying, I am okay with inflation risk as long as I own the companies that can manage it.
So it is rotation, not panic, that connects to the title of the week's narrative arc, which felt like cash on the sidelines versus still invested, just shifting. Does that fit?
It does. If you look at market behavior, the reaction wasn't a flight to cash, it was more like a rotation to economic resilience. That is consistent with a DCF view. If discount rates move modestly higher, you rotate away from long duration cash flows toward nearer term cash flows, or companies with more tangible pricing power.
And the risk to that view?
The risk is that energy stays elevated long enough to force a more restrictive policy stance. If the central bank feels inflation expectations are reaccelerating, the market's soft landing narrative gets stress tested. In valuation terms, you'd have to lift the discount rate across the board, which compresses multiples. That is why I'd call this a watch and verify moment, not a celebrate and forget moment.
I like that phrase. All right, let's pivot to the second story: the Fed holding rates steady while keeping the door open for future easing. This was a week where policy headlines were loud, but the market's reaction was oddly calm. Why?
The conclusion first: the market is now focused on the rate path rather than the rate level. Holding steady doesn't surprise anyone. The narrative shift is whether the next move is delayed by inflation pressure, especially from energy. In valuation models, what matters is the long-run cost of capital and the range of plausible outcomes. The Fed's message this week was, we're on hold, but we're watching the data. Investors interpreted that as a steady baseline with a wider distribution of outcomes. That didn't crash the market, it just widened the range of fair values. And that is why you saw dispersion.
I am hearing dispersion a lot this week. That lines up with what we saw, some groups stronger, some weaker. But why didn't the Fed's caution spook investors more?
Because the Fed wasn't closing the door, it was acknowledging uncertainty. The key is that policy is responsive. If inflation eases, the path is still there. If it doesn't, the path slows. That is not a binary shock. It is a probabilistic adjustment. When I build scenarios, I don't need a definitive policy promise. I need a plausible range. The market got that.
I want to press here, there were also political headlines in the mix. How do you account for that?
As a valuation person, I treat that as a policy overhang, not a direct input. It can affect risk premia, but it is usually second order relative to cash flow durability and balance sheet strength. If headline risk rises, the market asks for a little more compensation. But the core driver stays the same. Can this company compound cash flows in an uncertain environment?
That is a very measured frame. It also helps listeners who feel overwhelmed by the noise. Now, connect this back to rotation. If the market believes the Fed might stay on hold longer, which types of companies get the benefit?
The benefit tilts toward businesses with near-term cash flows and durable pricing power. If the discount rate is perceived as higher for longer duration equity gets more sensitive. So you rotate to companies that can earn and reinvest now, not 10 years out. The other beneficiary is firms with balance sheet strength, because higher rates tend to reward financial flexibility.
You are basically saying the rate narrative didn't break the market, it refined the filter the market uses to separate winners from losers.
Precisely. And that is a healthier dynamic than a one-direction market. It is also a market that can handle shocks better, because leadership is broader and less dependent on a single theme.
That is a good segue to our rapid fire section. We'll move quickly, focusing on what these headlines mean rather than what happened. First, multiple stories emphasize that the Fed held rates steady while citing uncertainty tied to energy and geopolitical risks. The meaning for investors isn't the hold, it is the patience. This is a market that needs clean data to move directionally, and that tends to favor steady, cash-generating businesses. Arjun, anything to add?
I just underlined the valuation point. When uncertainty rises, the risk premium rises. That doesn't kill all equities, but it raises the bar for growth assumptions.
Next, the oil shock story wasn't just an energy story. It spilled into inflation expectations and shaped the dollar and yields. The meaning commodity shocks are now a macro variable again, and the market is relearning how to price them.
Agreed. In my narrative to numbers framework, you can't model inflation without considering energy shocks. They reprice your assumptions.
Another key theme, central bank communication, tried to be steady, but investors read between the lines. The meaning, the market expects a longer pause unless inflation data cools, and that drives the rotation we keep discussing.
And it emphasizes balance sheet resilience. A higher cost of capital punishes leverage.
Finally, the political chatter was loud, but the tape didn't follow it. The meaning, policy noise matters at the margins, but investors are anchored to fundamentals and macro data.
Which is exactly how a mature market behaves.
Okay, let's check our prediction scorecard from last week. We said volatility would stay contained as long as data didn't surprise dramatically. That largely held. We expected leadership to broaden beyond a narrow tech narrative. That happened, the call we missed. We thought energy would be less of a driver. It turned out to be the macro spark that reshaped the week. That is a useful reminder that in macro, one shock can quickly change the story.
That is a fair assessment. I'd add that our base case assumed inflation would remain a secondary topic. Instead, the oil shock pushed inflation back to center stage. The lesson isn't to be pessimistic, it is to be flexible with scenarios.
Let's pull out the key lessons. Lesson 1, the market can handle shocks if leadership is broad and fundamentals are stable. This week wasn't about a single index, it was about which companies had pricing power and cash flow resilience. Lesson 2, rate expectations aren't static. They're part of a broader narrative about inflation drivers. And energy just re-entered the picture. Lesson 3, policy overhang creates noise, but it doesn't replace the need for valuation discipline. If you take away one thing from this week, headlines screamed chaos, the tape whispered rotation.
That is exactly right. And from a valuation lens, Rotation is a signal that the market is differentiating more carefully. It rewards reality-based assumptions over optimistic ones.
Now, let's get practical. Here is next week's watch list, 3 items that are observable and will help shape the narrative. First, watch energy futures, not because we need to guess prices, but because persistent strength there will keep inflation risk in the conversation. Second, watch the next batch of inflation data. If it softens despite higher energy, that is a big signal. Third, watch credit spreads and corporate bond issuance. If capital markets stay open, it means the system isn't stressed.
I'd add a valuation twist to each. If energy stays firm, expect more dispersion among industries. If inflation surprises lower, you could see a temporary boost to long-duration equities. And if credit spreads remain stable, that supports the idea that higher rates are manageable rather than constrictive.
Before we close, a quick listener note. We're not giving recommendations here, we're giving frameworks. The goal is to help you understand why the market behaved the way it did and how to think about what comes next.
And if you are building a model or just a mental model, don't anchor on a single narrative. Use scenarios. The market is telling you to stay flexible.
That is our weekly wrap. Thanks for listening to Capital Sound. If this episode helped, share it with a friend or leave a review. Arjun, always a pleasure.
Likewise. Thanks, everyone.
We'll be back next week with fresh perspective and fewer headlines. Until then, take care. End of scripts.